Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. Doing something slightly different today. I want to take a look at my overall investing strategy and also share with you guys my overall top holdings going into 2024. I'll share my entire individual stock portfolio. I think it's just fun to do that. You can kind of see where I'm invested, not necessarily where I think the best values are going into 2024, because sometimes selling shares creates a big taxable event that I don't want to deal with, and I still have faith in the company. But other times I do make some sells, as I did recently, to raise some cash when I think things get a bit frothy. They might be right now, but as always, I could be completely wrong. That's the beauty of this channel. This channel is called Time in the Market. The whole idea here is that time in the market beats timing the market, and my investment strategy, as you see, is driven by the majority of my money being invested in the market, whether it's individual shares and or index ETFs at all times. And I think this year was a good illustration as to why that matters. If you asked me in the beginning of 2023 whether or not the stock market would do fantastic, I'd probably say, maybe not. Interest rates were rising. There's always talk of a recession. We had that banking crisis during the middle part of the year, and yet none of that really mattered because the S&P 500 is up 25%. The NASDAQ is up 55%. And if you missed a year like this one, you're in a bit of a pickle when it comes to your long-term return. So if you were bearish, if you were out of the market waiting for a better deal, that could be a problem. And that's kind of shown in this graph right here that shows how missing the market's best days is very costly when it comes to investing. And whether it's best days or best years, you're in a bit of trouble, because this shows that if you missed just the 10 best days during the 1993 to 2022 S&P 500 period that they're looking at, your returns would have been 54% lower than if you were in the market at all times. Now, obviously, the reverse is true. If you missed the 10 worst days, you would have been a lot better off. But how likely are you to be out of the market perfectly to time it so that you are capturing the best days, missing the worst days? Very unlikely. And if you're just missing the best days, one or two or three missed best days can have a huge effect on your long-term returns and have you scrambling to chase the market, whether you're an individual investor or an index investor. Just missing those days is the bad thing. So staying in the market for most people is probably the right idea. And it's the right idea for me too, because I don't think I can effectively time that stuff perfectly 100% of the time. So that's why my investment plan is simple. 80% of my money is in the market, in the stock market at all times. And the majority of that money, as you see here in this graph, in this allocation pie, is in stock index funds, primarily the S&P 500. Some of it is individual stocks because I enjoy the analysis of stocks, of investments. I enjoy it as a hobby. And then the rest is in cash and bonds, depending on how I feel about the market any given month. And right now, I am 81% stocks and about 19% in bonds and cash. And bonds are short-term bonds, so they're easy converted to cash. And that kind of shows you that I feel a bit uneasy about market valuations today, because when I think the market is valued well, fairly, whatever, that stock allocation will get closer to 100%. When I think the stock market is a bit overvalued, frothy, whatever, that stock allocation will drop to that 80% minimum. And it's pretty close to that 80% minimum. And it got close to that 80% minimum recently because I made some sales in December. I sold Salesforce completely, eliminated that entirely from my portfolio. I sold Chipotle completely, eliminated that entirely from my portfolio. And I sold a bit of Apple, and I'll say why in a second, but Apple is my largest holding by far, so selling a bit of it isn't too bad. And yeah, these are taxable events, but I did want to take some profit off the table. I wanted to have some cash in case good values arise. And even in a bull market, good values can arise. You can kind of see that I've bought a variety of companies, all of which I've made videos on, and those have had pretty decent returns for the most part since I bought them in a short period of time, because bull markets have pauses, they have dips, and valuations can rise. And having some cash for me is just makes sense. And again, I'm going to be in the market at all times. I am not a day trader. When I buy these companies, I buy them with the expectations that I hold them for a long time. CRM, I actually only held for about a year because it basically doubled in the last year. So I didn't feel that strongly about the company when I bought it. And it became, a top six holding for me, so I wanted to get rid of it. And then Chipotle I've held for 4 to 5 to 6 years, and it's basically a 4 to 5x return for me. I just don't feel that strongly about the company anymore. I still love Apple. I think the valuation is a bit rich at the moment, but it's a company I'm comfortable holding. But I felt like selling a little bit to raise some cash made sense. So at the end of the day, I'm always going to be in stocks. The majority of it is going to be in index funds. This kind of allocation allows me to sell stocks at any time, sell individual stocks at any time. If that number, if that sale brings me below my 80% threshold, I just throw it into index funds. I never sell my index funds. And because my individual stocks have performed better than my index ETFs, that piece of the pie has grown larger because I put more money until more recently into index funds. And that might continue to be the case because this year was another year of outperformance due to my holdings. And even though I've been buying mostly value-ish type plays in recent months, the majority of my portfolio has been in growth, and that has done really well for me. I've provided this graph here that you can look at that shows my individual stock allocation, which is, the percentage on the side here. So you can kind of see that Apple almost makes out a third of my individual stock portfolio, as well as overall returns on a cost basis, so exclusive of dividends essentially. So Apple has become a huge portion of my portfolio because it has provided a 600% return since I bought it. That is pretty impressive, and that includes additional buys as the stock price rose. So my cost basis on Apple is somewhere in the neighborhood of $25. And that's why it's become such a good portion of my portfolio, because the stock has performed ridiculously well, including in the last year, because I think Apple, I have the data set here, is up 55% year to date since 1/1/23. And that is hard to argue with, but it also puts the stock in a position where it feels a bit overvalued. And this also speaks to my investing thesis when it comes to buying the stocks. When I bought Apple, it was trading at a 10% free cash flow yield, and I kept buying it as it traded in that 8 to 12% free cash flow yield range, as it did all the way up until like 2019 or so. So you had so much opportunity to buy this great company at a free cash flow yield that was amazing. And I had the cash to do so because of my investing strategy, because I had the ability to have some flexibility with my cash. I wasn't plowing it all into index funds. And I just waited for opportunities like this one to arise. And when it arose, I jumped into it head first and made it a huge portion of my individual stock allocation. And it's done so well since then that I've been rewarded. And as you kind of go down the line, you see a repeat of situations like that. My second largest allocation is a variety of Brookfield companies. This is a Canadian alternative asset manager that does a lot of different stuff. These returns aren't really indicative of overall returns because there were a bunch of splits that happened within the last year that changed BAM, which was the primary holding at the start of 2022, into BAM, BN, and BRE. So returns there are a bit slanted because of that. Overall returns there have been solid as well. As you go down the line, you've got Genius Sports, a company I did a video on recently that is my, I guess, fourth largest holding, but really it's my third because I kind of consider Brookfield as a combined entity. Then you've got Google, Microsoft, Amazon, Nvidia, which is up 486% since I bought it, Facebook or Meta, Formula One Group, Costco, Crocs, which is a new acquisition. You can kind of see Crocs, Realty Income, PayPal, Etsy up 23% there since I bought it. ASO up 42% since I bought it. Warner Brothers Discovery are the new acquisitions. You can kind of see my portfolio here. I'm not going to go into the details of every company. Most of these are pretty well-known companies. I can certainly make videos on any specific ones if you'd like to see them, but I will share a link to this portfolio in the description down below, and it should be live. It should update the allocations and gains as the stock prices move up and down. And if I add or remove a company, you can see it within this portfolio. But I'll try to make videos like this about every quarter or so to sort of share where I am with my portfolio, if I've added any new companies, if I bought any new companies. For buys, I'll generally share those on Twitter, or I'll mention it in a video that I'm probably going to buy a company based on the valuation analysis that I do. But right now, going into 2024, I feel like I'm in a pretty good spot. Do I think some of these stocks are a bit overvalued? Yes. Am I planning to sell anything more? Not really, because I'm pretty close to my 80% minimum, but also because I feel pretty comfortable with this portfolio. The one thing that I don't like about this portfolio is that it just has too many stocks. And one thing I might end up doing is kind of looking at this, 0 to 1% allocation group and seeing which companies I want to trim, which companies I want to get rid of. Because having 42, I think, individual stocks is a bit too many to keep track of. And potentially I'll get rid of a bit more Apple in the near term, especially if it keeps going up, simply because I don't like having 33% of my portfolio in one stock. A lot of that is because it's done so well. So I certainly don't want to trim because it's done so well. I don't want to punish winners. But also, if you think about Apple, the fact that it's 7 to 8% represented in most of my index funds, it becomes such a huge portion of my overall holdings. It's a bit of a portfolio that's top heavy. And if Apple performs really poorly, I could do really poorly. But overall, if you look at the portfolio year to date based on these allocations, again, this isn't going to represent perfectly my overall returns because I bought some of these stocks at different periods of time. I didn't buy them all in January 1st, 2023, but at least year to date, the stocks within the portfolio are up about 57.5%, which is a pretty fantastic return if you think about it. If you look at the stock chart itself, there's no stocks that I have a negative return on. And that doesn't speak to my investment prowess as much as it speaks to how fantastic a year this has been. Pretty much every stock has done well. There are some stocks that are, basically flat or close to flat that I may look at and see if I want to get rid of them or see if I want to buy more because maybe that's a good value proposition. I've been buying Markel recently, for example, even though that stock is up only 1%. That's a company that I really like. Kind of a baby Berkshire, if you will. Do a lot of the same things that Berkshire did when they were smaller, acquiring companies, having a venture business, all of that good stuff. But there are some companies that I want to look at here and see if I want to hold them for the long term or if I want to get rid of them, see if there's any valuations that are really, really frothy. I do generally sell portions of stocks. For example, the trade desk used to be a top 5 position for me, but I've taken profits since that has been the case. Tesla used to be a top 5 position for me, taken profits since that has been the case. Nvidia used to be a top 5 position for me. I've taken some profits, but still held a relatively sizable holding in Nvidia. Still think there's a lot of upside there, depending on what happens with AI. They're certainly the leader there. So overall, this is my portfolio. Let me know what you think about it. I thought it was fun to share it. My top 5 holdings are Apple, Brookfield, a variety of Brookfield entities, Genius Sports, Google, and Microsoft, followed by Amazon, Nvidia, Meta, Formula One, Costco, Crocs, this is a new acquisition, Adobe, Realty Income. And then as you look at my overall allocation, the index funds for the most part are the S&P 500, a small allocation to the NASDAQ to be a little bit more tech heavy, although my individual portfolio is already tech heavy, so maybe that's not all that good an idea. And then I also have an allocation to essentially an index that mirrors the S&P 500 Dividend Aristocrats. Those are technically individual holdings that are held within an M1 Finance account, but I don't generally see them as individual holdings because I just track the entire S&P 500 Dividend Aristocrats index. So it's kind of an index to me, and it lies within the index allocation. So let me know what you guys think about my strategy, about my portfolio. Any stocks you see here that you would get rid of, any stocks you see here on the bottom end, especially that you would get rid of, or even on the top end, anything you would add to, any stocks that you think I'm missing. One thing that I think about as I made these videos is I often set price targets for stocks that I like, that I'd buy at. And there's plenty of times where that price target has hit and I've just been like, nah, I won't buy it. And then the stock has gone up 70% since then. Sonos is a good example of that. This was a stock that was trading around 11 bucks. I think when I did the video, I set a price target around 9.50 or somewhere thereabouts. My phone buzzed that it hit that price target. I said, Nah, I won't buy it. And now the stock is up about 75% since then. So, there's always misses you make as an investor, but maybe the reverse would happen. As you kind of look at the year-to-date returns on some of these stocks, Nvidia up 246%, insane. Meta up about 188%, CrowdStrike up about 140%, Tesla up about 140%. All of these tech companies doing amazingly well. Really can't complain about overall returns for this portfolio. I said in one video that I went to Hawaii for 3 weeks. I spent, you know, a lot of money on that vacation because we did not take it easy on our expenses, multiple multi-$100 tasting menus and things of that nature. I came back and my portfolio more than covered the cost of that trip within that 3 week period. Again, guys, time in the market. You miss those 3 weeks and you're screwed. So why am I at 18% in cash if I think that's the case? Well, for me at least, I want to have some fun with this. It's not all about the end result. Overall, my individual stocks have outperformed the index, so I'm probably doing something right. Maybe that won't be the case in 2024 or 2025. Maybe I should be in stocks fully all the time, but this whole thing is a journey. If you enjoy doing the analysis, if you enjoy investing in stocks like I do, I just want to have some flexibility. I want to have some flexibility to buy shares that I think are undervalued, sell shares that I think are overvalued. Sometimes you win, sometimes you lose. The batting average does not have to be 100%. As long as it's, probably 60 to 70% overall, you'll do pretty well, especially if you can hit on something like Apple, which for me is up 600% and is really doing the heavy lifting here. Is it investing prowess? Is it luck? Who the heck knows? But hopefully for you, this was a good year too. Let me know how your year went. Let me know what you think about my portfolio. If you like it, if you hate it, or whatever. If you like these types of videos, let me know as well. If you would like to see them quarterly or something like that, kind of like a 10Q or something of that nature of my investment portfolio, I might just do those. So as always, thanks for watching. Like, subscribe. To all the new subscribers, welcome. I'm approaching 1,000 subs. That's kind of neat, I guess. Happy early new year. Thanks for watching. Bye.